Hello all. Welcome to video 8 for module 6, chapter 6. We talked about auto expenses and leases for employer-owned automobiles. In this video, we have a couple small details to go over for illegal payments and the reconciliation, but the bulk of this video is going to focus on the taxation year. Just a second. Yeah. So the bulk of this video is we're going to talk about when you have a business, what is your business's fiscal year? So getting started, the first small detail to go over, and it was already mentioned that interest and penalties associated with late tax filings are not deductible for income tax purposes. The government does not want to incentivize not paying your balance. In addition to that, it does not want to incentivize any action that's counter to the law. So, really, any illegal activity that results in fines or penalties, also illegal activities such as bribes, if you get parking, if you're a trucking company and your drivers get parking tickets or speeding tickets, none of those can be deducted against income. You'll have to pay them, but you can't deduct it against income. If you were to be allowed to deduct it, it would then be saving you money on your taxes, and they don't want to have that incentive cycle. So they generally just have the rules not allowed. The slide itself says inventory, illegal activity carried on with time, attention, and labor devoted to profit-making activity is considered a business. Those profits are subject to income tax. Expenses are allowed within the limitations stated in that 9, 12, 18, 20 rule. But Tax Act Section 67 is where it prohibits the deduction of bribes and a wide range of fines, penalties, tickets, parking, and other traffic violations. So even if you incurred these penalties and tickets during the course of earning income, in my example, you're a trucker and you get pulled over for speeding, you cannot deduct it against your business income. So we've named a number of things that are limited in their deduction, specific deductions that can be taken. For example, landscaping costs may be considered capital for accounting, but are deducted for taxes. So this creates a separation, or at least a difference between what income are you reporting for accounting and what income is actually to be taxed. So the starting point of this reconciliation between the two is we start at our accounting income based on accounting principles. And the reason we do this is because most businesses should already have this information. If they're reporting their financial statements, if they're tracking their revenues and expenses, we have the starting point being those records. Accounting income is an after-tax concept. Therefore, income tax expense is added back when reconciling. When they say it's an after-tax concept, whenever you have financial statements, included on those statements is usually an estimated accrual for what the taxes are going to be based on that income. So your financial statements will have an income tax expense reported. You have to add back that expense on the taxes because you cannot deduct those expenses. And the other thing is that estimate has to be corrected for the actual taxes calculated on the return. Important to understand the difference between accounting treatment and income tax treatment. If a difference is identified, then we need to adjust to reconcile. So if we have, here's my accounting income, oh, we have some expenses here that aren't allowed. Well, we need to detail that reconciliation that gets our accounting income into our taxable income. This is on a T2 form for corporate taxes. This is Schedule 1. Schedule 1 follows a reconciliation. So I've put an example in the spreadsheet for an income reconciliation. For the textbook 2025 to 2026, I believe it's on page 363 if you wanted to see the summary list of things to add and things to subtract. But generally, we would have our financial statements. Let's say our financial statements has our net income at 1.2 million. The first thing we would add back is a tax expense if it was there. Then we would add back amortization. Our accounting records might have some capital gains on them. but capital gains are reported differently for accounting than taxes. By and large, taxable income only includes it 50%. So the accounting gain on the assets, let's say the gain was $20,000, that needs to be removed from income. This income is including $20,000 for capital gains. So we deduct it down here, we remove that total gain, and we add back just the taxable portion, that 50% of the total gain. We have meals and entertainment. We'll have to add back half of that number. So if our meals and entertainment expense was $48,000, we're adding back to income 24,000. Because remember, that meals and entertainment is an expense that's already been deducted from our income. So on our financial statements, we have our revenues, our various expenses, and amongst those expenses was $48,000 for meals. Then we have to add back that 50%. So that's all Schedule 1 does. It takes our starting point, our accounting records, adds back certain deductions that either are to be removed from income or taxable amounts that are to be added to income, and then we can deduct. So amortization is an accounting treatment that needs to be added back to income, but we then get to deduct CCA. So our various additions and our various deductions will get us to a new number. So our accounting treatment said, oh, our net income is 1.263 million. But once we do our reconciliation, it changes from 1.263 to 1.292. So about an extra $30,000. So we netted our taxable income an increase of $30,000, and this number is what we'll pay taxes on. So I have a small list of various other items that would be added back. Premiums on life insurance, we would have to add back if it's not for financing, and other various examples. Now to get into the bulk of this particular video, taxation year. So individual taxes is pretty straightforward. For an individual resident, it's almost always generally the calendar year is what we report taxes on, January 1st to December 31st. But if your business is incorporated, corporations don't have to abide by that calendar period. They can use any fiscal period. And a fiscal period is any sort of business year. And it doesn't have to be that to follow the calendar year. So corporations can use any fiscal period they want as long as that period does not exceed 53 weeks. Changes to established fiscal year requires ministerial approval. So basically, once they choose their year end, that's sort of their set year end until they file paperwork to have it move. So corporations will choose their year end on a number of reasons. Some corporations do choose a calendar year end. They choose January 1st to December 31st to be their fiscal year, just to keep it in line with the calendar. It helps keep things pretty simple, especially when they do their own taxes. But they might choose different things. So one thing is they might choose just a slow time of year. Let's say they're really busy in the winter. They deal with snowmobiles. They sell snowmobiles, so they're very busy in the winter. But during the summer, they really do not have a lot of activity. So that's a great time of year to do the bookkeeping, get the administration work done to do their year end. So they might set their year end, their fiscal year end, to be June 30th. And then so that way they get to the end of their fiscal year, they have the summer to clean up their books, to file the return before they get into the fall preparing for their busy winter season. They might choose to be in line with a funding program. So the Canadian government's year end is March 31st, for especially in a lot of their nonprofit funding organizations. So charities tend to choose the same year end period of March 31st. It helps align their activities with the activity of the funding organization. They might choose based on, we know that bonuses, if declared can be expensed in a fiscal year, but aren't included in income until paid. So they might set a year end, say October 31st, so that they can have the end of their business year, they can calculate a profit, and then they can declare a bonus to be paid in January. So that bonus will be within the 6 months, but will be included in the individual's income next year. So these are considerations for choosing a year end. If a business is not incorporated, it's filed in the tax return of the individual. So because it's filed with the individual and individuals file taxes based on a calendar year, the taxation year usually follows the same calendar year. Businesses can use a non-calendar fiscal year, and I'll talk about that in more detail. Business profits and losses are included in the calendar taxation year of the individual based on the calendar year in which the last day of the fiscal period of the business ends. So if this company carries on a business as a sole proprietor, the fiscal period of the business ends July 31st, 2025, then Yishuan is required to include the business profits for the fiscal period ending July 31st, 2025 in the 2025 tax year. So what that means is a non-incorporated business doesn't have to use December 31st as their year end. If they choose a different point in the year, say July 31st, they still have to report that business income in that 2025 tax return. So for this reason, non-incorporated businesses, sole proprietorships, almost always choose December 31st as their year end to keep the two things in line. Having your business year end different than the calendar year when you're filing a calendar-based tax return sort of complicates the function. So even if your business year end is July 31st, you still have to file the business income based on the 2025 calendar year. So what the election does, the election is specific for the first year of the business, non-calendar fiscal year period. If available in first year of business, only available in the first year of business and filed by June 15th of the year following the year in which business commences. This section of the Tax Act 34.1 requires the individual to calculate and include stub period business income to December 31st for years following the year in which business began. And Tax Act 34.1 Part 2 allows prorated amount to be included in income for year in which business started with respect to first fiscal period of business that begins in year and ends in next year. So the wording of those two subsections basically says this. If you choose a year end that's not December 31st, so let's say it's July 31st, even though we pick July 31st, the accounting records or the year-end financial statements that say, here's my revenue, here's my expenses, will be reported in 2025. Additionally, we have to estimate the stub period from August 1st to December 31st and report that as well. So even though our year ends July 31st, we still have to report the business activity between our year end and our calendar year. So our individual tax return still includes January 1st to December 31st, even though the tax year is in July. So this is why it's complicated, because your fiscal period for your business is not necessarily going to match the business income you're reporting on the tax return, because the tax return has to be corrected to a calendar year. What the election does is if we set July 31st of our income, in our first year of business, let's say we started it in October, that first tax return is going to be from October to July. And then our next tax return is going to be from January 1st to December 31st. So what the election does is, since we normally have to report on a calendar year, it allows us to just take that October to December and report it on the last tax return. Instead of having sort of a bulky tax year, that first filing, it allows us to do the separation for December 31st from that period. So our reportings going forward will stick to that January to December. If it sounds confusing, I understand. This subject is low priority for this course. In practice, most sole proprietorships don't go for this election. They just keep their fiscal year January to December since they're required to report that period anyway. Since that's the period they're required to report, if they keep their business fiscal period the same, it really simplifies their tax filing. So here's the example. Jack Partowski forms a new business on November 1st. He chooses January 31st to be his year end. So between November 1st and January 31st, his business profits were $25,000. So this period is 92 days. For fiscal period February 1st to January 31st, his first full fiscal year, he made $80,000 of profit. Now the period between February 1st December is 334 days. So what do we do? He When we do the 2025 tax return, since his first fiscal year end was in 2025, this business income of 25,000 is going to be included in that return, 2025 tax return. 2025 covers January 1st to December 31st. So we've included November, December, and January in this tax return, but we also have to include February to December. So we take that $25,000 and we divide it by 92 days. Yes, we divide it by 92 days. So what that does, $25,000 divided by 92, it took us from November 1st to January 31st to earn that 25,000. So we earned income at a rate of about $271 per day. That becomes our daily rate. Using that, we estimate the next 334 days from February 1st to December 31st. So times 334. If that rate continues, the rate that we originally earned, we are guessing or estimating that we're going to earn another $90,000 by December 31st. So we have to add that to our income. So when we file our 2025, we know we earned $25,000 because that fiscal year ends past, plus this assumption rate for the rest of 2025. So our 2025 business income is 115,000. That's what we will report in 2025. So Mr. Partowski is being taxed on estimated business income of 14 months, January to December, plus November, December of the previous period. Then, when we do next year's tax return 2026, we have to report the actual business income we earned, which was $80,000. The question said for that fiscal period, we earned 80,000, but we already reported 90,761 from February to December. So we'll subtract the income we've already reported and paid taxes on. So 80,000. So we've kind of reported too much income. So $80,000 was earned. We had already reported 90,000 last year, but then we do our estimation again. So this was a full year. We earned $80,000 in a full year divided by 365. Now our daily rate, our estimated rate is we earn $219 a day. When we multiply that rate by 334, February 1st to December 31st, we expect we would have earned 73,205. So our fiscal period ended, we earned 80,000, and we're estimating we're going to earn another 73,000 from February 1st to December. Because we already reported too much income last year, our net business income in 2026 is $62,000. So you see how having this off calendar year complicates it because we have to accrue income to the end of the year, and then we subtract that income that's already been reported last year. Okay, yeah. So the last detail that's not on the slide that I want to talk about is, so when we talk about that election option, in 2025, we're essentially being taxed 14 months because November to January 1st is being included in our 2025 return. What the election allows us to do is when we file 2024, that November 1st to December 31st, we can elect to break off those 2 months and report their income in the first year. So instead of waiting for that first fiscal period end, we can just file those 2 months on their own. Exercise 613 deals with this. Mr. Morgan Gelato commenced business on March 1st, 2025. Because it will be a slow time of year for him, he intends to elect a fiscal period of January 31st. During the first fiscal period of March 2025 to January 2026, his actual business profits were $102,000. What amount of business income will we include in 2025 and 2026 income tax return if he chooses the first year election, and two, if he does not choose the election? Like I said, this is a low priority exercise. I don't think we're going to have you do this calculation on the quiz. But just to show you what's happening is if we elect to include the income in 2025, our business, you know what, let's start with no election. If we have no election to include the income, that $102,000 will be included at their first fiscal period. We started March 1st, 2025 and ended 2026. So since our first fiscal period ended 2026, that entire $102,000 is going to be added to the 2026 tax return. But now that we've established that first fiscal period, we must now accrue income from February 1st to December 31st. So $102,000 from March 1st to December 31st. Right. So since this $102,000 was for the fiscal year, March to January, we take $102,000 divided by 337. We get a daily rate, and now we have to prorate it from February 1st to December 31st times 334. That's $101,000. So we reported our year-end income of $102,000, and we're accruing $101,000 for February to December. So in 2026, we have a huge business income, $203,000. But March to December 31st was 306 days. Most of our first fiscal year was in 2025. So let's opt to take the election. Once we include it, the election allows us to take some of that $102,000 and bring it into 2025, that first year. So we take our income, prorate it based on the number of days. So now we're prorating that 102,000 divided by 337 for the full period times 306. So of the 102,000, 92,617 occurred between that March 1st to December 31st. So there's our income. That much can be included in 2025, so we'll put it here. Business income year end was $102,000, but we've already reported 92,000 of it. So the difference comes into 2026, 9,383. We still have that same accrual for February 1st to December. So now the income's 110 instead of being $200,000. So this allowed us to break up the income over 2 years, which would have put us in lower tax brackets for those 2 years. So this election would have had significant savings only for the first year, that first fiscal period in 2025. After that first year, it's the same accrual. So if we earned $102 next, 102,000, we're still going to report the 102,000. We still have that accrual going forward. Yes. So that's the business income. That's the effect of the election. I'll say it once again, this is a low priority. I think you need to understand what the election's doing, but I don't think we're going to ask you to calculate that first year election income. Okay. We have one more video left in this chapter. We will talk about restricted farm losses. So thank you for your time. I will see you in the next video.